Hello everybody, today we're going to talk about risky refis. This is Randy Patrick, your host, putting the realism back in real estate, and it's Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Lots going on. I'm going to try to keep doing maybe daily videos now the best I can. As I said, there's a lot of information going out there, and nobody wants to watch a 40-minute video. I get that. Okay, even myself. I don't even want to make them that way. But that's how it goes sometimes, right? Anyway, if you're not already a subscriber, if you could do me a great favor and honor and subscribe, I'd really appreciate that. It helps my channel grow, etc., etc. So get into it right now. This is actually kind of an article that I think really wasn't picked up. And just so you guys are clear, and I just like to say this because I want to make sure that you guys know what I'm thinking and what I'm doing. I obviously see the thumbnails and the headlines of other people who produce videos. I don't really like to, and I don't watch other, producers, creators' videos on housing because I don't want my opinions or thoughts or perspectives to sort of be influenced by what they're saying. So I see what they're talking about based on their titles. I also see a lot of comments. I read some of the comments. I know a lot of you guys are looking at multiple channels, which is fine. So I just try to always be a little different and trying to hit a different perspective than what's kind of obvious out there. But really what caught my eye the other day was very interesting. So this is kind of the neat situation here is we got this was on wolfstreet.com, Wolf Richter's site, which I like to look at. I do think he has a great perspective on information and it's well written, so I do enjoy it. There's a lot of good comments on there as well too. This is interesting though. Alarm bells ring over refinance mortgage boom. Why are refis so risky? So this kind of slid under the radar. So you have your GSEs, which are government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac. And I guess they slipped through the other day what's called this adverse market refinance fee, which basically is anybody doing a refinance starting, and this fee is going to come into play starting September 1st. Anyone doing a refinance on a loan that they are backing, they're going to be subject to a 0.5% fee. Now, 0.5% is not much if you really think about it. When you divide that, when you add that on and and over the course of the loan and amortize and the whole bit. But the point here, which I find is again interesting, and if I had my tinfoil hat, I'd put that on right now. It's yet one more sign. If you guys know me, you know that I like to talk about things that spark my interest and signs. So when I see something happen in industry that it gives me the little red flag going, okay, why are they doing this? What do they know that we don't know? It's pretty obvious that you see a lot of different groups out there are preparing or trying to counteract, or we'll say building a slush fund for all, slush fund, whatever you want to call it, to protect against what's going to happen in the future, which in all means is going to be a lot of defaults, mortgages, foreclosures, distress, things like that. So I just basically, when you take a look at this, as the mortgage industry is in uproar over the surprise announcement by Fannie and Freddie Wednesday night that they would charge a 0.5% adverse market refinance fee on refinance mortgages that they buy. And this is as a result of risk management and loss forecasting precipitated by COVID-19 related economic and market uncertainty. So that in itself is a pretty telling statement. And what I mean by that is that they obviously see problems in the future with respect to where the housing market is going, where values are going, and also, I guess you could say, a homeowner's potential, we'll call it economic, personal economy, that can they pay or can they not pay their mortgage down the road. So they're looking at this as, we need to start to build protection for us in there. Obviously, Fannie and Freddie got killed the last housing crisis, and it was calls for better management, calls to privatize this. In theory, this whole, when you have the Dodd-Frank Act and everything all on top of all what's going on with the GSEs, Fannie and Freddie should have been privatized by now, and they're not. So again, they are guaranteeing so many mortgages out there. They're the big brother and sister of the mortgage industry. And from when I see stuff like this, I go, okay, yeah, one more group or person is going, we're not too convinced where this housing market is headed, or we actually know where it's headed, and we're going to build in some some coverage for ourselves right now before it gets out of control. That's really, my perspective on things, which, listen, good for them, but again, one more sign for us. So if you actually take a look at this, and I'll put the article link when you can just find it, go to his website. But, it's neat because the fee is effective September 1st. It gives you an example. If you have a refinance of $500,000, the fee would be 0.5%, which is $2,500. So it's not the end of the world. Mortgage lenders pay this fee to the GSEs, but they'll try to pass at least part of this on to the borrower. So that's the whole thing. So realize they're charging the lenders this. So do you think the mortgage lenders out there are going to eat that fee themselves? Absolutely not. They're going to pass this on to their clients, which are you and I. So either we're going to see it in rates, or we're going to see it as a line item on the closing statement on your when you refinance, you're going to have your line items, and the title and escrow company will do the closing, and the refinance will take place, and this will be a fee on the closing statement, so you'll be paying for it one way or other. So realize the fee will be applied to cash out and non-cash out refi mortgages. So again, cash out to me is you're taking money out, you're kind of equity stripping. Non-cash out, just really rate and term, you're just lowering payments, etc. So again, interesting concept here. So who profited from the refi boom and who carries the risk? Well, 20 lobbying groups representing the mortgage and real estate industry, including the MBA Mortgage Bankers Association, National Association of Realtors, our friends at NAR, National Association of Home Builders, responded with a letter opposing the fee. Funny, they would do that because it would threaten the emerging but unsteady improvements to the national economy. I guess you could say, and raise refi costs, which would be particularly harmful for our nation's low and moderate income homeowners, and would be therefore contradicting and undermining Fed policy. So, great. So that's their standpoint, which you would imagine. Turns out these 20 lobbying groups don't represent anyone but their clients in the mortgage and real estate industry. Mortgage bankers, mortgage brokers, real estate brokers, home builders, and others. And these clients have all hugely profited from the refi boom that the record low mortgage rates, which have dropped nearly 1% since January, have brought about, which is clear because we know that refinancing is, certainly greater activity than purchase mortgages right now. So none of these clients in the lobbying groups carry the risks of the refi mortgages. The GSEs, which are Fannie and Freddie, carry those risks. And ultimately, in the end, if you remember what happened with respect to the bailouts, these guys got bailed out. I forget the number. I'm thinking 700 billion was the number for these guys. I don't remember. 700 billion, I think, was TARP payments, but they had their own separate bailout for Fannie and Freddie. But in the end, us as the taxpayer has to fund that burden. So clearly, if they're taking this money up front from homeowners, they're certainly acting in more, I guess you could say, a better fiduciary responsibility in protecting the economies of the taxpayers, etc. Right? So why should we fund somebody else's mistake? Is how I look at it. Now, this is interesting. So when you take a look at what they're into and how much they're actually Fannie and Freddie are actually backing, you're going to be surprised. So it says here the GSEs are already strung out on refi mortgages, according to the AIE. The AEI is the American Enterprise Institute, and they do analysis and talk about mortgages and home building and the real estate market, etc. So they had their 2 cents on this. So the GSE's share of the entire cash-out refinance market is now 90%, up from about 75% at the beginning of 2020. That's how exposed they are. So clearly, if we have some major swings in values, if we have more issues with respect to job losses, COVID issues, whatever, they are exposed to big time losses if people don't pay their mortgage. So yeah, this is 0.5% at closing. It's not that big a deal. The GSE share the entire rate and term refinance. So the GSE share of the entire rate and term refinance market is now at 80%, up from about 63% from the beginning of 2020. So the entire refinance market is 80%, but more the cash out market. They have 90% of the cash out market. So to me, that's the red flag right there. You want to jump in, we've hit some high watermarks on appreciation. Hey, I'm going to pull some money out right now, get a better rate and term, but I'm going to pull 20, 30 grand out. Well, typically, that's wonderful. And, what are you going to use that money for? You're going to put it back into your property for home improvements, You might add a room or do remodeling because that's more of a trend right now with respect to what's going on and people relocating or moving away from their offices and working from home, et cetera, et cetera. But in the end, a lot of money for refis is just used for a lot of people to make ends meet or to pay off credit cards, debt, things like that. We're back to using our house as an ATM, which was a major factor back in the last housing crisis. So I say this every so often when we talk about mortgages. Everyone seems to blame, when we talk about the mortgage meltdown, the mortgage crisis, the first thing that comes to people's minds are subprime loans. The subprime market or the mortgage market crashed the economy. Well, the subprime mortgage market was problematic, and it did kind of start sort of the housing crisis or contribute to it at the beginning. But in the grand scheme of things, the subprime mortgage market was only about 20% of what really happened. And the biggest culprit was just this cash out refis that people were pulling out at the height of the market, pulling the cash out, using the cash for other things other than at home improvement. And then when the market swung in the other direction, they were exposed, and Bob's your uncle. That's what people say, right? So anyway, recently the combined volume of cash out and rate and term refinance rate locks have been more than double the level a year earlier. That's how much the refi market has boomed under the record low interest rates. So of course, and why wouldn't you, right? If you've got a great rate and great term and you can actually pull some money out or save a few $100s per month, by just refining, the exercise makes sense. It's a financial equation. And then especially over the course of a 30-year loan, you're saving how many dollars? The one thing that people don't remember, though, is say you're already in a 30-year mortgage and you're in, say, year 7 of the 30-year mortgage. Well, if you refinance again, you refinance really for another 30-year mortgage term. So you're still, maybe you're saving those dollars, but you're actually increasing the term of your mortgage. Again, you're actually adding on to what you'd already paid to date with the refi. Just food for thought here. So anyway, the whole idea basically saying, which is interesting, is that mortgage lending history teaches us that lending into a vacuum is dangerous, and nothing indicates that more than a massive increase in share compared to one's competitors, the AEI said. It's because these guys have such a huge share of the marketplace that they are exposed. The new half-point market adjustment fee is not only appropriate, but it would have been a dereliction of regulatory oversight not to have taken the action, they're saying. So that's good. So they're praising the GSEs. The AEI is praising, complimenting the GSEs for doing this. Now, again, interesting part right here we want to talk about. Risks for rehis are high because of home values may be fantasy. So part of what goes behind the scenes with a lot of mortgage lending that everyone doesn't really realize is that people or the mortgage companies, lenders, whatever, they're trying to, CFPB, all these groups out there are trying to make mortgage lending more digital, more streamlined, et cetera, et cetera. So follow this train of thought and you can see why the exposure is massive here. So a cash out refinance mortgage with a 30-year fixed rate fully documented with a 65% loan-to-value ratio, meaning the loan amount equals 65% of the home's value, seemingly has a lot of equity, okay, and thus seemingly has a lot of risk, has the same default proclivity under stress as similar purchase mortgages with a 91 to 95% loan-to-value ratio. So their analysis has showed that if you have a homeowner who just bought their home and they've put down whatever, less than 3.5%, 5%, 10%, whatever that is, that once you've refied and pulled your cash out, you're just as vulnerable with a lower loan to value under stress to default from that loan. Okay. In other words, seemingly low risk refis are as risky as much higher risk purchase mortgages. Compared to purchase mortgages with equivalent metrics, refis are much riskier. And the GSEs currently guarantee cash out loans up to 80% loan to value, the AEI said. So again, don't forget the GSEs are guaranteeing these loans, and if they go belly up, who's paying? Ultimately, taxpayers, right? The major reason why refis are so much riskier than purchase mortgages is the simple fact that there is no arm's length transaction and no arm's length purchase price that determines the value of the home. So it boils down to this question: what do you need the value to be? I'm going to give you an example right here. And this is so clear. This drives the point home. So you know what? When you buy a property, so you're buying a home from a builder or you're buying an existing home, right? There's listing history, there's comparable sales in the marketplace, and you place an offer on the home. You do your inspections. The lender sends an appraiser out. There's an appraisal, so you've kind of got a third-party value, of what the home is worth. It's going to be comparable to recent sales in the neighborhood, et cetera, et cetera. So I guess you could say that there's no bailouts given. There's no, hey, you're not buying it from your mom, or your parents aren't providing you the money, so to speak. So you see, sometimes like that's an arm's length transaction when there's no other influences, no relationships in the transaction that can influence value or price, etc. So I guess what they're saying here is that when it's a refi, it's kind of like there's no sale, there's no buyer party that's looking to get a deal on the property, and thus disputing, or I guess you could say trying to establish a position of value with respect to their offer price in a purchase. You see, so this kind of keeps it kind of open, which is kind of weird. And as I said, it boils down to the question: what do you need the value of the home to be? Back in the day, and I can tell this from firsthand experience because I remember being in our office, and we'd have the countrywide account executives coming in. And at the time, I was working with a group of people who were doing real estate, who also did some mortgages as well too. And this is when it was 2005. That's the year, and things were still booming, still out of control. Countrywide, was having massive champagne parties, and everything was great, and they're signing loans. So literally, the account executive would come in to your office and say you had a purchase that you're trying to sell a property. You had a buyer for it, and you'd say, well, listen, I got a great guy, we use Countrywide. Okay, we'll hook you up. So your buyer is using Countrywide. The account rep would come in, and we literally would look at the deal. And the whole idea is that, well, we want to basically do certain purchases. We want to get the best rate or best deals. So they would basically call up the appraiser and say, hey, it's got to be this. Okay, make it $500,000. It's got to be $500,000. So the appraisers were told where they needed the appraisal to be at, and they then had the number in their head, and they had to find the properties to match that value. As opposed to now, where they're not told where it has to be at. They go and do their appraisals, and then the value comes back, and then if it doesn't work, then you can dispute it or order a new appraisal, or then you can't do the loan and you got to just find somebody else. But the point is that, what do you need the value to be was asked, and was not even asked. It was asked by the appraisers. It was told to by the account executives at the lenders, and especially on things like investment properties, where investor properties you had to have certain it was so much LTV. So if you were below the LTV, you didn't bring any money to closing to buy the property. So that's why they would say, hey, it's an 80% LTV. If we had it at $600,000 appraised value, then you're buying it for X. You know what I mean? So there's ways to play where you don't have to bring cash to the table to close, and that's no down payments, things like that. You see, so it was a way to circumvent and move property and do a lot of things without you taking money out of your pocket. And they were writing loans and off, and it was great. That's how this all kind of grew, right? So in the end, as we say, no appraisal, no problem. This valuation has been further heightened, or the valuation risk has been further heightened by increased use of automated appraisal waivers that the GSE used to decide whether no appraisal is needed. So now there's no arm's length transaction, not even an appraisal. So some of their underwriting systems, automated underwriting systems, AUSs, and loans may be submitted multiple times. The system is subject to gaming. We saw this happen with waivers of income documentation back in the 2000 years, etc. So yes, some of their, I think I read somewhere that if it's under $400,000, that these guys don't need a formal appraiser to do an appraisal. They'll have their systems do it. So now you take a one step back from an actual person going out to evaluate the property and using their skill, their state license, whatever, to give their determination of value. So this is, again, one more opportunity where, as they say, you can game the system. And automated systems make it much faster to distribute system-based underwriting rules and home price information to the marketplace. Given the GSE's 60% market share, it would be hard to design a system that would be better at fueling refinance demand and risk. So essentially, there's no arm's length transaction here, and they're taking away human intervention for checks and balances. So therefore, high risk, and things can go out of control. All right. So realize that that's problematic, and that to me, that's just, it just makes sense here. So again, I just find this interesting. So what's the whole point of me talking about this, you may ask? Well, as I mentioned earlier, it's a sign, right? So the words, these guys are saying, hey, we're getting hit with a significant amount of cash out refi business, 90% of the marketplace, and a lot of just normal, just rate and term refis. That if property values keep going up, number one, number two, they've already done their analysis, so they have to know what's going to happen back, in the next little while with foreclosures, forbearance, moratoriums, auctions, whatever. So realize that as much as I always mentioned here, that we as information recipients from the media or from CoreLogic or Adam Data Solutions, whoever, we're seeing after the fact pay counts of what's happened, what's filed, results. The GSCs, the lenders, they see real-time data when their clients are 30 days down, 60, 90 days, 6 months down, a year down. So they see stuff happening before it's even brought to the foreclosure process. So my point here is that they see what's going on. For them to do something like this is a telltale sign that they see risk in the marketplace. However, they're letting it go. They're letting people buy. And, do you think that this is going to stop anybody? Half a point fee is not going to deter anybody from getting a GSC type mortgage. It's not going to deter anybody from getting an appraisal as well too, because if you're pulling money out, what's a half point, right? Again, if it's show that example, $500,000 home, half a point is $2,500. That half a point's typically paid as a closing item on the closing statement, and if it's probably rolled into the overall cost of closing costs, which probably roll into the overall refinance as well too. So if you rolled everything in to your closing, then you're paying that $2,500 monthly over 30 years, okay, which is nothing. So in the end, as I said, just something to think about, something unique, and it's one more sign that some group of entities are going, you know what, we need to take a look at what's going on here and maybe put in some control measures or ways that we can minimize what we think will be future problems and loss down the road. All right, guys, appreciate the likes, appreciate the comments and shares. If you could share your video with the family and friends, I'd really appreciate that. There's my email if you want more information. Things are going to get crazy as time goes on here. But again, I look at it going, it's starting to take shape with all these little things that we're hearing. We're hearing about CoreLogic, talking, as I mentioned a few videos ago, decrease in home values. We see delinquencies are up. Now we see groups like these GSCs going, we need to start covering our losses in advance because we've been through this before and we know what's potentially going to happen here. So food for thought, something to think about. Guys, take care. We'll look forward to talking to you later on this week.